Listen up, everyone. Just recently, the guy who has been the most rock-solid bull for the last 3 years, Tom Lee of Funstrat, suddenly threw a wet blanket on this market frenzy. He is predicting that the U.S. market could see an epic correction of up to 20% in 2026. Do you realize how big that is? It means your account balance could shrink by a fifth in just a few weeks. It means the Nasdaq could wipe out an entire year's worth of gains. In technical terms, a 20% drop isn't just a correction, it touches the bear market red line. Almost every mainstream media outlet and panic retail trader will be screaming crash, end of the bull, and bubble burst. If you only look at the numbers, that fear makes total sense. I mean, if even the bull in chief is turning, isn't that a sign the party's over? But if you blindly buy into the bear market talk, you're making a massive mistake in logic. Because when you look at the second half of Tom Lee's warning, you see this plunge isn't what it seems. This 20% hole isn't an accident. It's part of the script. In fact, without this bloody crash, the S&P 500 couldn't hit 700, or even 8,000 by the end of the year. This isn't a trend reversal. It's a strategic cleaning. Big money is planning something most retail investors can't even fathom. They want to use an extreme deep dip to shake out trillions in profits and high leverage debt to fuel the recovery bull coming in the second half of the year. In this video, we're going to peel back the layers of this crash warning and look at the washout logic inside. Why is this drop actually a 7,700 entry ticket that only a few people will be brave enough to pick up? To understand why the market has to fall, we need to look at data that most people ignore, but Wall Street elites see as a time bomb. NYSE margin debt. This is the most hardcore measure of market speculation. It shows how much people are borrowing to buy stocks. According to Tom Lee's team, by November 2025, this number hit a record $1.2 trillion. But it's not the total amount that scares the big players. It's how fast it's growing. Data shows that the year-over-year growth rate for margin debt is nearing 38%. Please remember that 38% red line. In a century of Wall Street history, whenever leverage grows that fast, it usually means the market is in a state of thermal runaway. It means the S&P 500 isn't a steady car anymore. It's an overloaded train full of gasoline barrels, and it's still accelerating. In this situation, any tiny spark may be a hawkish comment from a new Fed chair, a bit of geopolitical friction, or even a random rumor could trigger a chain reaction. So, the crash Tom Lee is talking about isn't a fundamental economic collapse. It's a systemic deleveraging. Big money needs a deep dip, a shakeout so violent it scares every speculator, to dump the high-leverage baggage and the weak hands. To help you understand this drop, Tom Lee used a great analogy. We are in a completely dark room. You can't see the exits or the furniture. The old logic of just buy the giants is broken because 2026 is a whole new ball game. We've got a new Fed chair, post-election policy fog, and a total shift in global geopolitics. This is why he calls the drop a policy shock or a stress test, not an economic recession. Distinguishing between these two types of bear markets is the secret to buying the dip. In a recession, like 2008, companies' earnings are broken and balance sheets are trash. The fall is long, painful, and takes years to fix. But a stress test, like 1987 or 1998, is just a temporary shock to sentiment and liquidity. These drops are fast and deep, but the recovery is just as violent. It's a perfect V-shaped reversal. Tom Lee thinks the 2026 market is like a rowdy kid testing a new teacher's limits. If I act like I am dying, will you save me? It's a game of chicken between Wall Street and Washington. So, Tom Lee isn't telling you to quit. He is giving you an entry ticket to the big party in late 2026. Tom Lee describes it like this. The market is a naughty kid and the new Fed chair is the strict new teacher. The kid will definitely act up to test the teacher's limits. In the market, acting up means a massive dump. The market is basically blackmailing the Fed. If you tighten liquidity now, I'll die right in front of you. While this is happening, visibility drops to zero. No one knows what will happen with Trump as tariffs, or if the new Fed chair will crash the market. Just to show who is boss. This policy fog is the perfect cover for big players to dump. They'll use your fear of the unknown to push the VIX to 30 or 40. When you see headlines like Fed out of control, remember, that's just the kid trying to force the teacher to give him candy. Once the teacher gives in, the reversal happens in a flash. Besides policy, there is a physical reason for the fall. The S&P 500 is simply the full. Earnings are growing, which is great. but prices are growing even faster. After 3 years of non-stop gains, valuations are stretched to the limit like a rubber band that has lost its snap. Tom Lee points out that the buffer for bad news is gone. When valuations are fair, bad news might drop the market 1%, but today, that same news could cause a 5% drop. That's why we need that 20% fall. It's a necessary valuation detox. Big money has two goals for this dip. First, get valuations back to the average. Trash the fake AI stocks and get P/E ratios back to an attractive level. Second, create a value valley. Smart money is sitting on the sidelines right now because everything is too expensive. You have to dig a hole for those hungry wolves to jump back in. You have to understand this. Counterintuitive logic. The drop is the fuel for the rise. Just like how the internet really started changing the world after 1998, in late 2026, we'll see AI actually delivering on financial reports. But there is a massive blind spot here. Do you think the Magnificent Seven will be the ones leading the charge to 7,700? If you're still using the old map of just buy NVIDIA on the dip, you're going to get lost. Tom Lee spotted a huge fishing moment recently. Microsoft's stock tanked after earnings, while Meta has soared on the same day. For the last 3 years, the Mag 7 were like conjoined twins. They moved together and defined the bull market. But now, they are moving in opposite directions. This isn't a fluke. It's the end of an era. The brainless ETF logic of buying the giants is dead. The market is now looking through a microscope at the actual gold content of each company. Meta rose because it proved AI makes their ads more efficient. Microsoft fell because the market is questioning if their massive AI spending will actually turn into cold, hard cash. In other words, money is no longer paying for AI concepts. It only pays for AI results. The Mag 7 alliance is officially over. Before the new leaders arrive, we have to avoid a killing field that's already happening. Look at the IGV software sector. It's in a technical bear market, down 25% even while the index hits new highs. Why shouldn't AI make software stronger? Tom Lee provides a logic that should scare every SaaS CEO. AI is the savior of software. It's a deflationary factor for it. For the last decade, companies like Adobe and Salesforce made easy money by charging per seat. But if AI can write code and handle business processes automatically, do companies still need to hire as many junior programmers or buy as many software licenses? When AI replaces the people who use the tools, the per-head business model of SaaS collapses. This is the invisible wash happening right now. For top-tier companies like NVIDIA and Meta, AI is a lever. For middle-tier software companies, AI is a competitor coming for their jobs. If you try to buy the dip on low-value software stocks, you're going to lose big. So who are the new kings? Tom Lee and Wharton professor Jeremy Siegel are looking at a wasteland that has been cold for 3 years, the S&P 493. These are the 493 companies in the S&P 500 that are in the Mag 7. They've been like the failing students at the back of the class, ignored and cheap. But the wind is changing. Siegel predicts that in 2026, the S&P 493's earnings growth will actually beat the Mag 7 for the first time. He even says if the S&P 500 is only up 5 to 10%, the equal weight index, those 493 companies, could jump 15% or more. This is because the AI dividend is trickling down. Phase 1 was the AI makers Mag 7 getting rich. Phase 2 is the AI users getting rich. Traditional giants in industry, healthcare, and banking are using AI to slash costs and boost efficiency. Their margins are recovering, but their valuations are still stuck in the past. Think of it like this. The Mag 7 are downtown mansions where the price is at the ceiling. The S&P 493 are suburban houses, cheap, and the subway just got extended to them. Smart money is moving from the crowded mansions to the high-value suburbs. That's the market breadth Tom Lee is talking about. The sector Tom Lee is most excited about and actually buying is small caps. Keep your eye on the Russell 2000 or small cap ETFs. Small companies were the biggest victims of the rate hikes because they are most sensitive to borrowing costs. But the script has flipped. Tom Lee says small caps are on the verge of a double whammy of gains. First, they are incredibly cheap, trading at decade lows compared to big caps. Second, the interest rate risk is fading as the Fed stops hiking. This is like a spring being held underwater. Once the pressure is released, it's going to pop. When the 2026 crash hits the golden pit, small caps will be the most explosive sector on the rebound. Tom Lee's firm, Fundstrat, is already telling institutional clients to buy IJT small cap growth. because it could be the dark horse that changes your financial status. But knowing the script doesn't mean you can play the part. When that 20% crash actually hits, you won't be looking at a calm chart. You'll be seeing collapse headlines, AVIX over 30, and terrifying losses in your account. Your instincts will scream at you to run, but you have to burn Tom Lee's words into your brain. This isn't a bear market. It's a deep dip. Big money is causing this chaos specifically to make you hand over your shares right before the dawn. If you sell at the bottom, you raid just the dead with being cleared out of the way of the 7,700 party. The first rule to surviving this is to go against your emotions and build a barbell portfolio that can stand up to the storm. On the left side of the barbell, Tom Lee says to look at a sector that has been ignored for 10 years, energy and materials. Because of ESG, money has avoided oil, gas, copper, and lithium. This has pushed the valuations of companies that run the physical world down to the floor. That makes them a very solid safety net. 3 trends are going to blow up this sector's value. Supply chain decoupling. When countries prioritize security over efficiency, owning raw materials is like holding the world's throat. The AI energy black hole. Data centers don't just eat chips, they eat electricity. Energy isn't a dying industry, it's food for computing power. Constant geopolitical conflict. In shaky times, physical assets are always better than paper promises. When the market shakes, these hard assets, with high cash flow and low valuations, are the anchors of your account. They won't go up 10% in a day like Nvidia, but they'll keep you from sinking and give you a hedge against inflation. On the right side of the barbell is your offense, robotics and small caps. Tom Lee believes robotics will take over from AI as the next super engine for the market. Look at Elon Musk. He is pivoting away from Model S X to bet everything on the Optimus humanoid robot. This is a gamble on the future of human demand. Why robotics? Because demographics are unavoidable. Developed nations have no more workers. Who's going to build the cars or take care of the elderly? Don't worry about robots stealing jobs and causing a depression. Tom Lee points to the invention of flash freezing in 1935. Efficiency gains have never caused poverty. They create disposable income and prosperity. The 2026 robotics wave is the biggest productivity leap of our generation. Then you have small caps, the spring that's most sensitive to rates. When the Fed has to calm the market after the crash, the Russell 2000 will explode. This is the best battlefield for investors looking to jump to the next wealth bracket. There's also one special variable, crypto. Tom Lee is split here. He has some concerns about Bitcoin because of how quantum computing might threaten older, unupgraded wallets. However, he is extremely bullish on Ethereum. His logic, the narrative is shifting. Ethereum isn't just digital silver anymore, it's becoming Wall Street's global settlement layer. Look at BlackRock and UBS. They aren't just doing ETFs, they are moving stocks, bonds, and stablecoins onto the Ethereum chain. When global giants build their houses on your infrastructure, your value is based on utility, not just retail hype. This is a controversial take, but the message is clear. The crypto market is moving from rising and falling together to a utility-based value phase. So, let's look at this 2026 map one more time. Up ahead is a 20% policy shock and deleveraging. In the middle are the wrecks of SaaS and fake AI companies. But on the other side is the golden coast of 7,700. How do you survive? Watch the VIX. When it hits 30 or 40 and everyone is selling in despair, that's your starting gun. Hold your barbell. Energy on defense, robotics on offense, and S&P 493, small caps in the middle. Stay sharp. Don't let the bull is dead noise distract you. This is a script designed to shake out the weak and make room for the true believers. The 2026 market won't be a no-brainer bull run anymore. It's going to be a wild roller coaster. The crash is the price of admission. 7,700 is the reward. Only those who understand the script, hold their shares, and keep their eyes open in the dark will be the ones celebrating at the finish line. Would you like me to create a summary table of the barbell strategy? Or perhaps draft a watch list of the specific tickers like IJT or energy stocks mentioned in this script? We are witnessing a transition from the overcrowded tech strategies of recent years toward a more resilient leverage balance. This transition from policy-induced panic to the realization of AI-driven profits represents a massive, interconnected redistribution of wealth. In this complex environment, what is most required is not emotional reaction, but a coherent coordinate system to connect these fragmented market signals. To help systematically examine this wealth transfer path, A high-granularity mapping tool has been developed based on the core logic of this cycle. The 2026 profit blueprint for the U.S. stock market crash. You can find the access link in the comment section below for your review.